I'm Charlotte McLeod with the Investing News Network, and here today with me is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Thank you so much for being here online with me today.
Thank you so much for having me today.
Of course, and thank you for agreeing to come on quite short notice. Great to have you here to talk. What we're going to be speaking about today is something that's a little different for our audience here, and that is the wild week we've been having in the markets, in particular with GameStop. I wondered if you could give me a very brief rundown of the situation there because it's quite complicated and very interesting.
Yeah, it's been a wild week for us as traders. Watching a stock like that, which arguably is on the footstep of a bankruptcy, go from $2 to 10 to 100 to as high as 500 today, or just shy of that level. It's been amazing, and it's really showing us that the power of social media is immense. You have people that don't have necessarily a lot of money, but when they all band together, I mean, on this WallStreetBets group, you have, I think it started out as just a smaller group, but just in the last week, it's grown to 3 or 4 million people on there. And when you have a 3 or 4 million people, even if they're just putting, $1,000 or $2,000 in a stock, it can make it a meteoric rise in these stocks. As a trader, you don't see that very often. In fact, I've marveled. I traded in the late 90s. That was really the beginning of my career in the dot-com bubble. And even back then, you didn't have social media like you do today. So that's really catapulted these stocks way higher than even I would have fathomed. It's gotten kind of crazy today because you had a lot of these brokerages like Robinhood restricting, whether or not someone could buy GameStop and some of these other stocks. And that's really made people upset because they look at it and they say, well, these hedge funds, they can do whatever they want. And here a brokerage is restricting whether I can basically buy the stock. They can sell it. They just can't buy it. And I agree with it. I think it's ridiculous. People have said, oh, well, these average investors are going to get hurt when the stock falls. Yes, but if you're buying a stock up 1,000% in a week, you might be deserving of a little slap on the hand. I hate to say it. So, I'm in the camp where the markets need to do what the markets do, and the markets will have winners and losers. And you have to let the markets do it. You can't restrict people. These are people that are all, of age. They've signed consent forms to open brokerage accounts. It's people need to do what they need to do. And I learned trust me on this one. In the beginning of my career, I took some massive hits because I did stupid things. But you know what? I learned from them. And that's the key.
And this is something that we've been hearing, or I've been hearing over the past year or so, as that retail crowd has come into investing more and more. It's that, yeah, you can do that, but you do have to be prepared for the consequences. So you would agree that, or not agree, I guess, that they should be putting these restrictions on the stocks that are having these crazy trading activity.
So I'm in the camp where, we're all consenting adults, right? I mean, in general, to open a brokerage account, you have to be of a certain age. You have to put a certain amount of money. The brokerage is supposed to pre-qualify you. If you're doing options, there has to be questions answered that say that you understand the risks of that. And if you do, then it's your money. You should be able to do it. What I don't think is fair is if they discover that there were certain institutions that were kind of goading this on, hiding behind a handle on WallStreetBets, saying, oh, let's buy another this many shares. I mean, if there were certain nefarious actions like that, that's not okay. But if it's an individual who wants to do whatever they want to do with their money, then that's their prerogative. It really is. Who is anyone to tell, me how to spend my money? I mean, if I want to go spend it on, at a strip club, for instance, or at, any of these type of places, that's my prerogative. So I think that's the way we have to look at it in this situation. And I do worry that it's going to come down to negative consequences on Wall Street and traders like myself, where does the government come in and say, well, now we're going to tax every time someone does a trade, we're going to put a tax on it to kind of make it so people aren't trading as much and speculating as much. And that's my big concern. That would be a real detriment to investors as a whole.
Right. And, just to be clear, we've been talking about GameStop, but this is not the only stock that's seen this attention from people on the WallStreetBets forum on Reddit. We also have, I think, BlackBerry, Bed Bath & Beyond, Nokia. I wondered if you could just weigh in or make clear what the unifying factor is behind all those stocks. Is it that they have the large short positions? What's going on there?
Yeah, it absolutely is that. So these people were very smart on Wall Street Bets that discovered this, and it's been something that's happened a ton of times in Wall Street's history, where a stock that is highly shorted, meaning that you have these big institutions, these hedge funds betting the stock is going to go down, sometimes to zero. They accumulate massive short positions, and then if the market suddenly goes up or that stock has good news, those institutions get squeezed out of it. So that's exactly what's happened. And these Wall Street Bets people discovered that if you get enough people to push a stock up, so you find a stock that has a high short percentage, you push it up, then these hedge funds have to start to cover, which when you cover a short, you actually buy it back. So it's forced buying. And it creates an even more big tidal wave going forward and just continues to propel these stocks up. Now, should GameStop or AMC have gone up this much? In reality, they went up because people were buying them. They won't stay up because the fundamentals aren't behind it. But again, that's the beauty of the market. The market, just like with Bitcoin or with gold or with anything else, it's, at this current point in time, what are people willing to pay for it? And as a trader, I look for that. I look for these disparities. Like today, we shorted XRT, which is an ETF that has GameStop in it. We couldn't really short GME, GameStop, because a lot of the institutions, the brokerages wouldn't allow us, but we were able to do XRT, and we were able to short it when GameStop was near 500 today. The stock came down. We took our profits on the short side, and then we went long when GameStop went to $125 today or so, and we wrote it up for a gain that way. And that's the beauty of the market and what you have to kind of expect going into this type of craziness. So it's definitely the short issue that's going on here, and it's really honestly it's a sign that the market is topping out when you get this euphoria. And let me just say one more thing here. When history looks back at this period in time, they are going to say, what was the root cause of these speculative bubbles? And the answer is the Federal Reserve. There is no doubt that the Federal Reserve, the easy money policy, interest rates at zero, meaning that everyone has to go searching for yield, which is in stocks, it creates these asset bubbles. And yesterday, Jay Powell was doing his press conference, and he basically blamed the bubbles on vaccines and the federal government giving stimulus. Yes, the federal government giving stimulus is part of it, but the Fed's been pumping money into the system since 2009. And it's ludicrous that they are not taking responsibility for their part in it. And honestly, history is going to look down on that. They are going to see it.
And where do you think that refusal to acknowledge their role in this comes from? Why is that?
I think they're in somewhat of a tough position. So if they acknowledge it, then it says, okay, well, we have to back this bubble away, which means we have to raise interest rates. If we raise interest rates, the stock market throws a huge fit and probably drops 20, 30%. If that happens, then the economy goes back into a tailspin to the downside because people are losing so much money. So it's a really tricky situation, but this is a situation they caused by having interest rates at zero for so long now and just continuing this QE policy of printing money and pushing it into the system. I mean, the M2 money supply has just soared in the last year. It has been ridiculous. I would be shocked if we don't see inflation above 2% by year end.
All right. And just going back to a couple of things you mentioned before, one thing I wanted to ask you is if this kind of situation in the market is something that you would ever get involved in yourself, or do you see it as simply too volatile? It sounds like you are kind of moving around the edges of what's going on. Would that be accurate?
Yes, I mean, being a trader for now 20 plus years, I've learned my lessons the hard way. So I'm very careful. Like I said, I did play an ancillary play, XRT, which is a retail ETF on the short side as well as the long side today. But I'm buying very small positions. Again, in my history, I've taken big losses in my beginning portions of my career, and it's not something I like to repeat. And I also have a lot of traders that follow me, and my responsibility is to keep them as safe as possible. So yes, we've traded it a little bit, but I haven't traded GameStop directly myself. Just more these kind of little plays around it where it's a little safer. You're not going to see these things go up 100% kind of thing.
Right. Okay, so I want to now take this around to the mining sector because one thing that's been going on as we've been seeing all this activity among the companies we've been discussing, there's also been some conversations around silver. Some investors on WallStreetBets seem to be turning their attention there. And today we've seen the silver price up, iShares Silver Trust up, some mining stocks up. What do you think could unfold there?
So I did hear that as well. I saw that they were talking about silver and trying to get it started. There's some big short positions in silver out there, and I think they're trying to ignite that same short squeeze. The only difference is, and they've pushed silver up today and some of these mining stocks up today. The only difference is there's a big difference between the market cap of silver, which is massive compared to a stock like GameStop, which when it started was only $1 billion company. It obviously swelled to about 30 billion. But if you're talking about 30 billion versus the all the silver in the world, there's a huge difference there. It's a lot harder to push something that's a lot bigger. So do I think they could get a little upside here? Yes, but I don't think they'll have the same success of seeing silver go up, 100, 200, 300% in the short term. Having said that, I think silver in the long term, just because of the printing of money, will have some upside to it. If you're a longer term investor, silver is definitely a place to be.
Right. Okay. Definitely very interesting. Now, we've talked a little bit about why this is happening. Where did it come from? What was the trigger? And you mentioned this is an indication that we're at the top of the market. So I do want to ask, with that in mind, is this something we can expect to continue seeing in the future? Is this something that people will have to keep in mind as they're like the big hedge funds and everything? Are they going to have to account for this possibility in the future?
They will to some extent. So just like when the dot-com bubble burst in 99, 2000, there was a period where there was a recoil by these big institutions in terms of risk, which is one of the reasons why the de-risking took place that drove the NASDAQ from 5,000 all the way back to about 1,200 at that period or during that period. So you will see that. But what you also might see is a shift away from the shorts in these names being so heavily in their portfolio. So they may decide to just spread it out a little bit more, their short plays. I don't know if they'll totally go away from it, but they're going to have to. I mean, you can't, in this environment, you have to adjust your trading. Just like in any environment, there are bull markets and there are bear markets. There's sectors that start to move big. And as a trader, the faster you adapt to that, the more successful you'll be. So they will absolutely have to adapt. Having said that, the same signals that we saw in 99 or 2000 are here. The same type of runs where you're seeing stocks go up 100% a day. I like in Tesla, which has a 1600 PE, forward-looking 200 PE. Cisco in 99, 2000 was the big mega cap that had a 200 PE on it as well. So there's a lot of signals that you want to be very aware of, including this euphoria from the retail investor. And one of the things too is, for years I heard, oh, the retail investor is not in this market. Well, guess what? They are in this market now, full in. So there it is.
Right. And, as we wrap up, I want to ask if you have any final words that you would share with investors on this situation. I think it's quite unfamiliar for everybody. So is there anything we're missing? What else should we be watching here?
Yeah. So number one is be a little more careful than usual. All right. When you hear everyone talking up a stock, it may run. Don't be worried if you miss it. Because again, like we saw today, GME was at close to $500 and it fell down to 125 and now it's in the 200 range last I checked. I mean, that's a big drop. If someone obviously bought it around that 500 or 480 mark where it was at the high, and if that person didn't exit, they're underwater. So remember, be conservative in this environment. I know you want to be aggressive. I know you want to go out and just make a ton of money, but sometimes it's the money you don't lose that it's more successful as an investor and a trader. In that respect, also just keep an eye on these type of things. The market really freaked out yesterday to the downside, the NASDAQ, the S&P. I wonder if it was kind of a blow, kind of a shot across the bow that the institutions are getting ready to sell across the board even more. So just be a little careful out there.
And should we be looking for like a market correction in the relatively near future? You're mentioning this euphoria in the space. What do you see there?
Yeah, that's the way I'm in the position now of looking is you can't see these type of moves where the retail, I mean, history has shown us so many times that when the retail investor goes all in, that's almost always within a couple months of the top of a major market correction. So I do think at least a 10 to 15% correction is probably getting ready to hit. My guess it'll coincide with Biden starting to talk about raising corporate taxes again. You know, we're going to have to pay for all this stimulus, all this money printing, and taxes are going to have to go up. Long-term capital gains taxes, the top rate for income taxes. That's going to be something that's going to reduce the profitability of a lot of these big firms like Apple if they actually start having to pay significant amounts of taxes.
Okay, well, thank you so much. I think we can leave it there. It was great to have you come on today and explain this. Certainly, it helped me, and I hope that it helps everybody who's going to be out there watching.
Oh, thank you so much. It was a real pleasure to be on.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Gareth Soloway with InTheMoneyStocks.com.